Nvidia was the grand finale to a stunning earning announcement season. Fixed mortgage rates fell below 6%, and the 10-year Treasury bond is now at its lowest level in 3 years. Are we teetering on an edge of an interest rate collapse? Welcome back to Navellier Market Buzz. Why did Nvidia not rally after announcing 73% sales growth, 82% operating earnings growth, beating analyst estimates, and then guiding above the analyst estimates?
Well, the stock did rally before the earnings came out, and this has become a pattern in recent quarters where they write so many cover call options on a stock, the Nvidia stock, that sometimes the tail's wagging the dog, to be honest with you. And so the Citadels, the Jane Streets, the Virtue Financials, when you write an option, you get free money. But if the option hits a strike price, you have to deliver the stock. And I think they just wrote a lot of options and didn't want to deliver the stock, so they run an algorithmic system or mean reversion system to take it down. Now, Jensen Huang, obviously the founder of Nvidia, he told investors in a news release that computing demand is growing exponentially. He says the Agentic AI inflection point has arrived, and obviously Jensen's very good for quotes, but he's also incredibly credible. So I think this is mechanical in nature, and we shouldn't worry about it. The stock should hit $300 a share by the end of this year and $500 by the end of the decade. Some time ago, I wrote an opinion piece in Market Watch that you should hold Nvidia to the end of the decade, because not only they dominate the regenerative AI chips, the Vera Rubin's being rolled out in the fall, and then there'll be another chip in a couple of years, and then after that, they'll try to dominate quantum computing, because they've been having all these quantum computing contests, and they have a quantum cloud simulator. So this is a stock that should be bought any dip, and I don't recommend anyone sell it.
So now, why are mortgage rates and Treasury bond yields falling?
Well, that's a very interesting conundrum we're in, because we had a PPI report that spooked people, and I need to explain to you what was happening. I was on Fox Business when that PPI report came out, and I said, I think it's trade services distorting it, and sure enough, as soon as I dug into the details, that was it. So you're showing an exhibit that shows that trade services were up 1.8% in December and 2.5% in January. And that is why the PPI came in hotter than expected. The good news is wholesale food prices fell 1.5% in January. Wholesale energy prices fell 2.7%. And wholesale good prices fell 0.3%. So the only thing that's screwing up the producer price index is this services component, which is new. We didn't have that a few years ago, the trade services component. So when we back away, wholesale good prices have fallen 3 out of the last 5 months, and last year they fell, I know, at least 3 months. And then we've got service costs up 0.8%. So it was a very confusing report. Everybody reacted to the headline, said looking at the details, and the bottom line is we have falling goods prices. That's deflationary, and that's all I care about. Fortunately, the people in the bond market were smart enough to see this. We now have the lowest mortgage rates in over 3 years. They're under 6%, and the 10-year Treasury cracked the 4% level. And so that's very, very bullish. So as rates come down, it will cause the Fed to cut. I think the Fed would like to see a weak payroll report for February. We've been having all these layoffs being announced, and we'll see if that shows up in the data.
So now for March, should investors take profits or accumulate strong stocks on dip?
I would buy on dips, but the markets do have to have profit taking every now and then. The question is it short-lived? The main thing stocks need at this juncture is positive analyst revisions. And because earnings largely come out, there's a few more coming out next week that we'll talk about. The bottom line is that as long as the analysts are revising their estimates higher, the stock should be accumulated. So I think we are going to consolidate here a bit. Whether we go sideways or have a correction, we'll see. The problem is I own all these gold stocks that keep going up when the market's going down. So some days it can counterbalance everything. Some days it doesn't. but we have a cushion built into the portfolio thanks to all those gold stocks.
So now, in the State of the Union speech, President Trump said the energy demand for data centers could unfairly drive up utility costs for many Americans. So what is the solution?
Yeah, Trump is a populist, and this is bothering a lot of people. Obviously, utility costs have gone up because we've gotten greener, but now Trump's turned on that natural gas spigot, which is the cleanest fossil fuel you can have. But the data centers are tapping into that natural gas too. So there's a perception out there that electric rates are going up due to data centers. But to be honest with you, a lot of it is the green solutions. But regardless of that, Trump proposed a taxpayer protection package that would require many technology companies to provide their own power and bypass the power there. So Grok did this in Memphis. He run a natural gas line to the data centers, and the data centers can be powered by Bloom Energy's natural gas fuel cells or turbines from GE Vernova or Siemens or Mitsubishi. And at Grok in Memphis, they're using turbines. Most people use turbines, but the greenest way is these natural gas fuel cells that Bloom Energy makes.
FedEx was the first large company to sue for tariff refunds in the U.S. Court of International Trade. With nearly 1,800 companies now suing for tariff refunds, what could this mean for the trade deficit and the federal budget?
Well, the budget concerns did not hit the interest rate environment. If we knew that we would have to refund all $170 billion, obviously that would maybe cause rates to spike. There would be budgetary concerns, but they didn't do that. And I think the main reason is Trump doesn't want to give it back. And the Supreme Court doesn't really have enforcement capability. They have this special court in New York to deal with this. It's going to take forever to process this. But you got to realize these tariffs were negotiated with countries. They have their laws. We have our laws. And, if they ask for a refund, guess what? Trump's just going to up the new tariff on them even more. So it's going to be interesting to see what actually unfolds.
Now, there are a few more stocks announcing next week. Let's start out with the stock that you have under management, Ciena.
Ciena is in our managed accounts for disclosure reasons, and it's recommended in my newsletter. Their sales are forecasted to be up 30.1%. Earnings is supposed to be up 81.6. We got very strong positive analyst revisions on this stock in the last 3 months, and the last 2 quarters they've had pretty big earnings surprises. So based on all the other data center related stocks that have beaten, I'm sure Ciena is going to beat. So this will be the grand finale.
Now let's switch to consumer spending. AutoZone tends to do well when consumers hold on to their cars longer. Are we still in that repair over replace cycle?
I think so. Their sales are supposed to be up 9%. Their earnings are supposed to be down 3%. The analysts have trimmed their estimates a bit, and AutoZone used to surprise, probably because they had a lot of stock buybacks, but they have missed 4 quarters in a row. So I would hope with that strong sales growth that they would finally surprise. But we'll see. And if they do surprise, it'll go back on my radar, but it's off my radar.
Electronics are big ticket discretionary items. Are shoppers upgrading again or still waiting on the sidelines for Best Buy?
Well, electronics is one of the durable good orders that really gets sparked. It does help to have a Super Bowl or a World Cup or something like that for someone to go out and buy a lot of stuff. But Best Buy has really overpowered the electronics marketing. And they have beaten the last 4 quarters, and this quarter is supposed to be spectacular. Their sales are supposed to be down 0.2%, and earnings are supposed to be down 4%. But compared to previous quarters, these are supposed to be much better earnings. And so they should be benefiting from holiday shopping. Again, they have this great surprise history. Minor analyst trims on this, but I would expect them to beat again. But longer term, people are going to be upgrading the size of their TVs because, TCL makes these huge 98-inch, 115-inch TVs a lot cheaper than everybody else. And Sony actually surrendered to TCL. Those two are combining, and Panasonic surrendered to another Chinese company. So China has decided to dominate TVs, and everybody will have to upgrade one day. And if they don't buy it from Costco, they have to buy it from Best Buy. I would just buy it from Best Buy to have them install it, because when you get a TV that's 98 or 115 inches, it weighs a few hundred pounds.
Off-price has been a sweet spot. Is Ross still benefiting from thrifty consumers?
Yeah, I think so, because they've surprised the last 4 quarters. Their sales are supposed to be up 8.9%. Earnings supposed to be up 15.3. That's excellent. It means their margins are expanding. And the analysts have been revising their estimates higher. And because of the fuss over tariffs, a lot of people think some of these companies are going to get windfalls because they might have paid tariffs that they get refunded thanks to the Supreme Court.
Target has faced margins and traffic pressures. Are we finally seeing stabilization?
And for their sake, I hope so. Target sales are forecasted to decline 1.4%. Earnings are forecasted to decline 10.6%. The analyst community has held their earnings estimates relatively steady, and this stock has started to surprise again. So I really hope so. They've taken some drastic measures to firm up their profitability, so let's hope they continue to surprise. But this stock will always be about guidance and getting the consumers back in the store.
Abercrombie has been a major turnaround story. Can the momentum continue?
Yes. Their sales are supposed to be up 5%, 5.2% actually. Earnings are supposed to be only at 0.2, but the analysts have held their estimates relatively steady, and last quarter they had a 9.8% surprise. So I have a lot of hope for this stock, and we'll see. But they deal with very smart, sophisticated consumers, and we'll see if they're still giving them what they want. When you get the tariff rebate on a lot of the clothes they sold.
Costco's membership model has been incredibly resilient. Is pricing power still intact?
Yeah, their same-store sales growth is stunning. Now, just for disclosure, I sold Costco. Your mom still has it in her personal account. And a lot of people are wondering, why did I sell Costco? A couple of clients made me buy it back. The main reason is just the absolute earnings growth isn't as strong as the but their sales are supposed to be up 8.7%. That's outstanding. And their earnings are supposed to be up 12.6%. That means their margins are still expanding. The analysts have revised their estimates slightly higher, and last quarter they had a 5.4% surprise. So everything's tracking well for Costco. The only disappointment they could have is this is a major gasoline retailer, and gas prices have come down. So sometimes that curtails their sales growth just a bit, just because of cheaper gas prices. But let's face it, Costco knows what it's doing, and I'm hoping for a good report because your mom owns the stock.
Groceries are a necessity, but are margins holding up as food inflation cools?
Well, Kroger's very, very well run, but let's face it, they have increasing competition from Sprouts Farmers Market. Aldi would be another example. Their sales are supposed to be at 2.2%. Their earnings are supposed to be at 5.2%. The analysts have held their estimates pretty steady in the last couple of months, but when this company does surprise, it's not big. Last quarter it was about 1.7%. So I would hope they'd surprise, guide higher, but it's not going to be in my portfolio because they just have too much competition.
Now let's switch over to AI and infrastructure. For CrowdStrike, cybersecurity is mission critical. Is enterprise spending still strong enough to justify the premium valuation?
All right, this is the premium cybersecurity company out there. Palo Alto Networks would be the other one. And CrowdStrike does a lot of protection for the cloud. Their sales are supposed to be up at 22.6%. Their earnings are up 7%, so that means their margins are compressing because their earnings aren't growing as fast as sales. We do have slightly positive analyst earnings revisions, but last quarter they only surprised by 2%. Before that, they used to have bigger surprises. So I am not that excited about CrowdStrike, even though I expect them to beat. It just doesn't have the sales. Well, it has the sales. It doesn't have the earnings growth I demand. And the margins are under compression. So such is life.
Broadcom has become a key AI infrastructure player. How much of that growth is already priced in?
It is. The stock's doing very well. Their sales are up 28.1%. Earnings are forecasted to be up 26.2%. We have positive analyst revisions, and last quarter they had a pretty big surprise, 4.4%. Before that, the surprises were small. So yeah, this is a very reliable company. Should beat. So I have no evidence that they won't.
Marvell is deeply tied to AI networking and data centers. Are we seeing acceleration or digestion here?
Well, Marvell's really interesting. Their sales are supposed to be up 21.4%. Earnings are supposed to be up 32%. That's excellent. That means the margins are expanding. They've held their earnings estimates very steady. They had a 3% surprise last quarter. So they definitely look like they're up and coming. And if they have a big surprise, they'll be on my radar.
Finally, let's talk about Norwegian Cruise Line. Are people still prioritizing travel?
Norwegian Cruise Lines, their sales are supposed to be up 11.3%. Their earnings are supposed to be up only 2%. but analysts haven't cut estimates, and they had a 3.3% surprise last quarter. People might be trying to take cruise ships more because of all that unrest in Mexico when they killed the cartel king. By the way, when I was through Denver Airport the other day, the flights to Mexico were back on to the resort areas that were burning up briefly. So, but people just might feel safer in a crowd or staying on a cruise ship versus a destination hotel. So we'll see. I have Royal Caribbean, RCL, it's doing great. And Norwegian hasn't been doing anywhere near as strong. So hopefully their business will pick up too. This is not in our portfolio, the NCLH.
Perfect. Well, thank you all so much for joining us this Sunday. We hope you enjoyed this week's video. If you have any questions that you want us to answer in this Wednesday's midweek update, please let us know. But until then, we will see you this week for a new